Hello everybody and welcome back. In today's video, we have a special weekend edition for you where we take a look at the stock, crypto and commodities markets for the week ahead, including the key levels that you need to be watching and of course what's going on with this volume in these markets. We've got a bit of economic news coming out, some key data points and of course some amazing levels for you to be looking at. So let's get into it right now. See you very soon. Well, welcome back and let's start talking about these markets. We'll cover crypto, commodities and some other things a little bit later, including our macro thoughts. But we need to start here on the S&P 500 heat map. This gives us an idea of whether it was risk on or risk off for the week ahead. And straight away, you'll notice it was pretty much risk on. Apple, Tesla, Nvidia, Google, Amazon, and energy all tended to do very well for the week. And what was really interesting about this, it was the week of options. We saw the retail trader get back into effectively disconnecting a few stocks, Apple, Tesla, Nvidia, just to name a few, and run them with huge gamma squeezes. Yeah, the gamma squeeze was back and it may continue into this new week. So some of the stocks that had this happen on them in 2021, they're going to be the ones for day traders to potentially be looking for an edge. One of the things you can do there is, of course, be watching the social media presence. If you see an increase in the amount of chatter, that can lead on to, of course, more options traded. And it's going to be the story, I would say, of the next couple of weeks. Let's talk about what happened on Friday, though. It was a bit of a trap day. We had options expiry and we saw retail push the market early, followed by a big sell-off, which would have scared a lot of people. We were down almost 1.2% on the Nasdaq at one point before recovering a lot of that into the close. If we then think about the actual sectors that were doing well, this is where things get a little bit strange. Almost every day we've seen minerals, metals, and technology, consumer discretionary, all of those leading the charts. This was one of the first days we saw utilities, agriculture, financials, residential, and of course, consumer staples all running up a lot harder. Now, it could be just playing catch up, but if this continues to happen over 2 or 3 days, let's say Monday and Tuesday, it could be an early warning sign to us that the market is ready to maybe have a bit of a dip here and move back down to some key supports. Remember, if they're going into those defensives, it could mean a little bit of risk off. At this stage, we're not getting enough signs of that. XME has been the best performer over the last month, so we've actually had metals and minerals doing the best here, or metals and mining. And this is really where I think a lot of people make mistakes on markets. They think, okay, I'm only going to look at the S&P 500, I'm only going to look at technology. The issue with that is there's other subsections that you can do very well in. If you were invested in metals and mining, energy, clean energy, solar, agriculture, look at or even gold. Your performance increase was huge. 4% on tech. Look how much money was in some of these other ones over the month. And that just shows you that sometimes it pays to look outside the box or think outside the box. Speaking of thinking outside the box, for anyone that watched our previous video, I'm just going to really briefly cover this idea that we're in uncertain times. We're in a midterm election year. That's check for uncertainty. The year of the trader. We've said that all of 2022. The other thing is we have incredibly high yields that we'll be looking at later. In fact, they just continue to climb. So is this actually just a bull trap that's a return to the normal, inverted commas, of a normalized market? Well, that's where things get a little bit sneaky. And remember, just because this chart has it going up 50% of the fib doesn't mean it can't go much, much higher before it pulls back. This is the big question that everybody's going to be asking. And I just want to quickly bring up some key points to this. March and April, since the 1950s in the stock market, have been incredible months. In fact, April's been one of the best months of the year to be invested in. May, well, not so much. Have you ever heard of the saying, sell in May and go away? Well, most people don't believe it. Fair enough. It hasn't happened in a long time. But is this the year that it actually does occur? Before I say that, there are some stocks that are performing better at this stage. And that was mentioned as Google and Amazon. Things like those stocks do tend to have statistical advantages over these periods. And the reason why is splits. This is just a great chart of splits versus the real market over periods of time. So we mentioned this idea of sell in May and go away. Well, here's 2008 Nasdaq versus 2022 Nasdaq. Very similar resemblances here in terms of decline and everything coming into the start of the year. Now, we're not saying we're in the GFC, but it's just interesting. We then see a pickup that goes, in this case, into June. But we do have that big kind of rally that occurs around. Remember, this rally was going into a pretty seriously bad time. It turned out to be one of the worst things that ever happened to the US economy. And to get out of it obviously required the big print. But yeah, that's what was occurring. Then we look over here at midterm years. And when we start to bring the data in here, obviously all midterm years, the blue one, first term midterm years, Democratic pres midterm years, and second year new term Democratic presidents, look at this. They all get these March, April, May rallies. So March into April, into the back end of April, and then decline. What have we got going into that point? We have earnings. We have the FOMC probably coming out with some 50 basis point hikes. Of course, they're going to back that up most likely with a couple of big hikes. You could disagree. Let's see what everybody thinks about the next big hike coming out of the Fed. But if we have earnings coming off first quarter, what do we all expect is probably going to occur there? Maybe they're not going to be as good as people think. Now, the market could be allocating it in, but if we get the right signs, remember technical analysis, which we'll be talking about soon, can give us precursors to weakness. And we have some great lead indicators that we want to talk about today that we believe in some ways may show us whether the economy is about to fail and fall back down or whether it's going to hold up strong. Here we have the US 2-year and it's getting out of control. I mean, it's at 2.27%. Now, the Fed's probably not going to be able to maintain or fix this, where they're basically hoping, they're hopium right now that they're being able to maintain it. But look at that steep curve of the increase here. The 10-year is very similar, 2.479. We're not at inversion between the 2-year and 10-year yet, but it's been bouncing up and it's now sitting at 2.5, almost going towards, you would think, that 3% plus. It's pretty amazing. Now, what's that doing? It's putting pressure on bonds. Of course, bonds are very sensitive to yield. And if you know how to read bonds, it's really about understanding that if bonds are declining, especially declining at a rate that's incredibly fast, on top of, a rate that's comparable to something like the yields fast, what this can be telling us is it can be telling us that the economy is incredibly sick. Bond traders tend to be smarter than stock traders. Don't ask me why, but they are boffins, and these guys crunch data. So they're selling off the TLT, the LQD. It's not a bear signal by itself, but certainly the way that I interpret bonds at this stage, actually, bonds are stabilized, if not going up in some ways in comparison to certain things. So yeah, the bond traders certainly look bad, but remember, it's very susceptible to the rates here. If we move over to gold and we think about what's happening with gold, well, it's increasing a little bit. A lot of people discussing the idea of stagflation. If you're not sure what stagflation is, I'd recommend you put a quick Google search in. Similar to the 1970s, gold actually did very well in stagflation. Gold does well in other points as well in time. However, it doesn't usually like high yields. In fact, high yields aren't necessarily a great thing for gold. At this point, it's still going up because we could be in the point of stagflation. We've breached past this resistance. We've then rallied through, come back down, rallied to a new peak, found resistance, becoming support. That's role reversal right here. And it looks like gold is set to try to test that 1974 level. So that's a zone or an area that we're certainly looking at. Because of the nature of the euphoria and the sell-off, we could be also looking at a bit of a pullback here that goes into the 50 to the 78.6 fib pullback. Somewhere in here is where we expect gold rally maybe to stop and have some real resistance. But very nice closures here on the last week. Look at this daily, very strong there. Nice big bullish kind of move, and a rally through these highs. You would think from a technical level could be signaling even higher points here for gold. So very significant movements through the last week. US oil, yeah, same thing. Very decent holding up of the oil over the Friday session and the previous sessions. We've got a fib put on here. We're looking towards it moving within that 50 to 78.6 zone and stabilizing. So hopefully it continues towards the 78.6. If it finds resistance there and starts stabilizing, it could be a sign that oil is about to actually dip back over and go back. Remember, it rallied, it fell, it's rallying nice like a dead cat bounce, but it still may not go to new all-time highs. It might just sit here and consolidate because there are going to be a lot of extra barrels coming online, we would suspect, over the next few months. Speaking of oil and a stock that's going crazy against it, that's Tesla. And Tesla has been the story of really squeezing. So this has been gamma squeeze and a huge amount of options that have been taken into the expirations. In fact, last week you saw 1,050 strikes, 1,100 strikes, and even 1,200 strikes on Tesla, really pushing the market around. Here we are sitting around $1,000 per share, and you'll notice that if it comes back down, there's going to be some buy levels that you would think that buyers will come in from a technical analysis level. Resistance, resistance, resistance at the 945. You would think that might be a very strong level of buying pressure from the technical level. And we also have a 9, 10, 50 exponential and 20 exponential moving average on the daily. So every time, the problem with this market, this rally, is people say, okay, I'm going to short it back down. Well, now that you've moved so far up, you start to create bullish zones of interest. And that, I think Tesla certainly does have that. Now, does Tesla have big resistance areas? Yes, it starts to stop every $50. So if it hits 1,100, is it going to have a problem? Around that 1110, you would think so. If it goes past 1,100, does it go to 1,200? Very possible. That's the next big zones here. If you put on a volume profile or anything else, these are the zones that if it starts to rally to, you would think sellers are going to take some profits, but still very big kind of gap ranges. A decent hold up here for Tesla leading into the new week. Apple's another stock that's disconnected from the market to a degree. It breached through the series of lower peaks here or lower highs. It's just on a serious rocket ship. I mean, this is now, if you're thinking how many days in front, 1, 2, 3, 4, 5, 6, 7, 8, 9 days of bullishness. Wow. I don't even know if I can really think of one. Over here, 1, 2, 3, 4, 5, 6, 7, 8, 9 days, then a red. So it's on a pretty big heater in terms of green, green, green. Again, though, if it does sell off here, which is a resistance zone, you can see again, resistance, 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 resistance. Whether it sells off around 175 or 182 and finds some resistance, we don't know. But if it does, and say comes down to 166, would there be buyers here? Well, I think you could make an argument that there's a technical zone. You've got previous resistance, previous support, previous resistance, support around there, a bit of a zone of demand. And on top of that, you've got a 20 and a 50 exponential moving average on the daily acting as dynamic support. So if there are sell-offs, or the sell-offs do occur this week in Apple, again, will there be buyers? You would think they would be in these present zones. You might say, well, that would be awesome. I would love to get Apple at 4.8% discount. These are the types of things that can occur, and you need to be planned and ready for them should they be happening on your technical charts with your technical systems. So a little while ago, we talked about some of the signs of lead indicators of either bullishness or bearishness. XLY here, obviously consumer discretionary, can show the American consumer. And right now that has broken out a few weeks ago, and it's something that we've been watching very closely. It's still continuing to rise, and that's pretty important. The American consumer at this stage looks strong on this chart. Whether you agree with that or not, it's really irrelevant. I mean, that's what the chart's telling you at this point. And you can see that it's continued to make a series of higher lows for now. Now, if it makes a new peak, where's the next level that you would expect it to go to? Somewhere around that 190 to 192 zone. So there could still be a bit of strength herein for the American consumer from the technical analysis level. How that helps us is it then helps us to go and think about, okay, well, do we like technology? If the discretionary trade is on, sometimes technology is coming with it. And that's what's been happening recently. Now, does this hold up? Well, here's XLK versus the volume weight or the weighted average here of the different sectors within the S&P 500. And what you'll notice is that we've had technical breakouts before, back in July into October of last year, and relatively technology actually held pretty well. Then we have here a series of lower peaks coming through, and we've just breached through that as well towards the strength side. We have hit some resistance in the 2050 moving average, but if we bring this down to something like a daily, look at this. It's still broken through that series of lower peaks, and it does look bullish. When we bring over something like a seasonality with this, we have very strong seasonality leading into what months? March and April. May, not so good, but March and April, quite strong here in terms of technology seasonality. And it doesn't mean that technology is the best sector to be in or anything like that. It's just interesting to see that when that trades are on and the time of year that we're in, it all tends to lead together with the same amount of data. So we also spoke about some lead indicators. One of those is Europe. Europe's incredibly sensitive to the Russia-Ukraine situation. We know that. I think everyone would agree the outflows from Europe were severe during the crisis period. Here we have the DAX, something that we certainly had here on the charts, talking about it as a Wyckoff. In fact, it was our lead indicator into knowing that Europe was suffering, and it sold off incredibly heavily, and it was a great Wyckoff on the weekly. Now we've recovered and we're holding a zone, we're holding a support here, and effectively now starting to coil or channel. Now, if the DAX breaks to the long side, what's that telling us? Things are okay in the economy for now. Whether you agree with that or not, you can totally disagree, but it does show you on the price action that's what's currently the trade. If it breaches underneath this zone here, could that be a first signal of maybe, we need to be careful about the markets around the world because Europe is becoming susceptible again to weakness? I think it would be a valid call in terms of the way we look at charts. Let's move over to IWM. It's the same thing we're talking about here. We may not like the Russell 2000 as an index technically to trade. It often gives us some falsy kind of things, but it's been channeling for a while now between these ranges. If we breach through the 209, 210 level, could that be a signal that risk is continuing to be on here for the month of April? And possibly then we have to really start looking towards the earnings at the end of the month. Well, certainly it could be there. We've got good support here in this red box zone around 200. And at this stage, after the Friday closes and the Thursday closes, it looks like it's trying to coil, getting ready for a breakout. We'll be watching, and of course it's one of those leads that you're looking at in the markets. Let's now move over to the Nasdaq. So the Nasdaq kind of looks like consumer discretionary in some ways. It's continued to rally here very, very strongly, and we still have some very big levels here for the week ahead. So where are all the moving averages? Well, if we were boxing them, we'd be boxing them around the previous peak here, this 14,300-ish zone. Resistance, resistance. Now we've got a 50 exponential moving average. We've got a 200, and if we actually scroll back over to the daily, what you'll notice is that you're going to have a 20 moving average sitting there if the market does pull back. At this stage, each sell-off has been met by huge buying rallies, and many of you have been trying to sell this market. The problem is it hasn't been easy to sell, and we have cautioned against that from the perspective of these rallies tend to really brutalize the pain trade. So the pain trade right now, it's still on the puts, and I'll show you why in some ways when you look at the options. So could we have pullbacks? Absolutely. Would the pullbacks be met by some kind of technical buy demand? It looks likely here when you're thinking about these levels. If you're considering the resistance points for the week ahead for the Nasdaq, that's somewhere around this daily 200 moving average, sitting around 15,000 to 15,200. That would make a lot of sense. But as we know, the best market to be looking at is always going to be the S&P 500. Where's the key resistance? 4,600. Why? Because that was key support, key resistance, and really stop the dead cat bounce here back in January, February. So is this going to be a point where you would see some resistance selling? You would have to think so. It makes a lot of sense. Now, if you're considering, again, if it rallies or starts dropping off here, what's it going to go straight into? Well, again, daily, 20 moving average and 50 moving average and a 4,400, that would be a very interesting zone. So let's just draw up some fib thought processes. If we have a fib run like this, where is the current 38.2 fib? A standard pullback, which usually gets buy demand. Well, from the current swing low to current swing high, a 38.2 puts us right around 4,400. Very interesting, right on that zone. Some people are calling towards low volume. I think when you think about low volume in a rally, you've got to go back over to other periods and say, well, is it historically really low volume? So historically, this was rallying too pretty aggressively. It was, I would say, around the same. And whenever you rally, you do tend to see a decline in volume. Just think about it this way. If you're rallying and I'm saying, you know what, I don't want to sell my shares, and neither do you. You don't want to sell your shares, maybe. You're like, no, I don't want to sell them. Well, really, someone's going to have to pay a higher price for someone to sell them to them, or they're going to have to pay a higher price and a higher price. We usually see more volume on the downside than on the upside, just the reality of markets. But it's still very important, and especially important when you're looking for a consolidation, accumulation, and distribution. Volume is no joke in those types of markets. Very important for us to bring it in. So 4,600, absolutely resistance here. Big level. 4,400, huge level. Let's get over to the options for the week ahead. So in the call side, I mean, we've got the standard 450 SPYs, 11,000 open interest. Okay, that's pretty interesting. But then we scroll down here. Look at these puts. I mean, people are going to lose some big money. So we've got here 360, 102,000 open. That's huge. Then we've got 380, 44,000 almost open. Then we scroll down, 25,000 open on 395. And the 400, 24,000. So it's still probably in the best interest of the market to actually still hold or don't go down, even for this week when you're thinking about these current expirations going into the 1st of April. If you think about how many calls are here versus the puts, guess what? There's still a lot more puts on this market. Look at these 400s. There's just nowhere near the amount of calls open. So it just shows you how many people had puts open during the period. And I don't blame them in many ways. Of course, there were times when we were looking at very heavy shorts here on the channel and times when we realized that things have significantly changed. And they may only change now for a month. I mean, the data is pointing towards around a month. The technical analysis currently is showing strength. That's what we've seen over the week. If we find weakness, what might be met by buying pressure. And I think that's the problem in these markets. It's hard to navigate in some ways for people because it's hard to switch mindset all the time. And that's the tough thing about this market. The mindset switches happen within days. Look at the Chinese market. They announce all of a sudden, oh, we've got your back, don't worry. What happens? The market goes up 30% in a day, and then 40%, and then 50%, and some stocks are up almost 100% over the next week. Like, it's phenomenal movements in these markets right now. Speaking of phenomenal movements, let's talk about Bitcoin. Bitcoin, we have reported, has looked a lot better in the last, I would say, 5 trading days, and it's going back towards the 45,000. At this point, I would almost think it's going to break out. Why? Because of the shorts. The shorts continue to remain incredibly low here. BTC shorts were going higher. They completely fell through the floor, showing that the big whales weren't interested in taking it short. And if risk-on sentiment continues in the stock market, let's just say it does continue, that's going to be bullish here for the crypto market. Now, will it have problems with this zone? Well, of course, it's had problems plenty of times. We've got resistance, 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 resistance. If it breaches out past this zone, especially with a weekly close, what happens? You would think that's kind of a go signal for many people, and then you'd be looking for retail to come back in. You'd be looking for a lot of open interest, a lot of social discussion, all of those types of things. Remember, technical analysis can often get you in early. And why? Because you're looking at the charts and you're watching really the psychology of the market. And then when the psychology snaps big key resistance zones or support zones, a huge amount of flow comes in, which is due to what you would really think is a huge amount of discussion online and FOMO coming through. 2050 cross here on the daily for Ethereum. We've already talked about the breakout of the downward trend here, which we discussed. We have liked this as well. It's going quite well. Hopefully can get through 3,200, but really Bitcoin is the one that's dictating this. And Ethereum may beat it as a ratio, because I think if you bring up something like an BTC chart right now and you do a comparison, Ethereum is significantly lagging Bitcoin right now in terms of its overall ratios. And that's important. It's a ratio trade. Has the ratio trade broken out of its last downtrend? You would have to think, yes. Imagine if it breaks past these types of ratios. This is the way that we conceptualize here on the channel, and it certainly helps us in making better decisions about what comparatively is the better potential here of an investment, of a trade, or of anything else. And of course, you can bring that into your own concepts. For the week ahead, there are some big bits of news. We've got the JOLTS job openings, 10 a.m. New York time. Here, we scroll down, we've got ADP non-farm employment change, the first number, 8:15 a.m. And unfortunately, yeah, that means it's that time again. it's non-farm employment time. So before that, we get core PCE price index on the Thursday, 8:30 a.m. New York time. And then, yes, we get non-farm payroll, 8:30, 1 hour before the market opens, Friday 1st, followed up by ISM manufacturing PMI. So these bits of news will affect the markets to a degree. The markets are sensitive to news to a degree at the moment because of the high VIX, the high volatility. But again, will it change the way you do things? It depends on the time frame that you're in. If you enjoyed today's video, please remember to subscribe and smash that like button, and come and follow us over on Twitter at FX Evolution. Did you know that pretty much the grocery store that when you go shopping is owned by about 10 companies? Yeah, it's not very diversified when you think about it. All right, thanks so much, everyone. Have a great week, and we'll see you very soon. Bye for now.